Hey everyone, it's Justin here, America's Honest Tax Accountant from Number Crunch Nerds. Welcome to video number 3 of my 10-part video series on tax planning for the year-end 2024. As mentioned in video number 1, starting January the 15th, 2025, and running through April 15th, 2025, I will be hosting a 2024 tax return preparation class. If you would like to sign up for that, you can use the link in the description below this video. Alright, in this particular video number 3, we're going to talk about some tax strategies that you may be able to implement before year end related to 401ks and IRAs. Then in video number 4, which will be coming out shortly, we will expand further on today's discussion by talking about backdoor Roth and these sort of similar mega backdoor Roth strategies. We're going to start simple and then work into the more complicated on these two topics. Let's go to the personal tax planning template. So if you recall from video number 1, we laid out our base case income and deductions for 2024. We filled out this whole column in the personal tax planning template and we compared the results to TurboTax to validate the answer. And now it's time to start looking through some of these lines and asking ourselves, what strategies can we implement potentially before year end that could either, number 1, reduce our tax burden for 2024, or number 2, if you are following my Roth IRA conversion video series on YouTube, we may actually be choosing to accelerate income into 2024 in order to reduce our overall lifetime tax burden and overall lifetime effective tax rate. But for purposes of this video, let's look at 2024 and see what items we can potentially reduce and thus save on taxes in 2024. So starting with these first two lines right here, W-2 income. If you have been following along and filling out your personal tax planning template, then in these two cells right now, you have your expectation of the full year income that you're going to receive from your W-2 position. Now, is there anything that could be done to potentially reduce these numbers before the year is over? Well, one possibility is that you could make an additional 401k plan contribution at work. Now, let's be very clear. I'm not talking about a catch-up contribution, which is just an additional annual amount that you are allowed to contribute for people who are age 50 and over. We'll talk about that one a little bit more in a few minutes. What I'm talking about for the moment is as follows. Many people will choose to contribute to a 401k plan at work, but often only up to the employer match. In other words, they will contribute whatever they need to get the full employer match. But that doesn't mean they've necessarily contributed the maximum that they are allowed to contribute from a tax perspective. So right here, the Internal Revenue Service announced today that the amount individuals can contribute to their 401k plans in 2024 has increased to $23,000. So let's do an example. Your employer matches 60% on contributions up to 4% of your salary. Your salary for this example is going to be $150,000 a year. So the maximum your employer will match is therefore $150,000 times 4% or $6,000. And to achieve that match, to get the full amount, you would need to defer $6,000 divided by the 60% match, or $10,000. And so that's what you decide to do. Or I should say, that's what a lot of people often decide to do, is they will contribute whatever they need to get the full match. But in this example, have you contributed the maximum that you are allowed to contribute with that particular decision? And the answer is no. As we just said, you are allowed to contribute up to $23,000. And so now let's say it is closing in on the end of the year. What is something you could potentially do with your last 1 or 2 paychecks for the year? Well, you could contact your employer's plan administrator and say, hey, can you defer 50%, 75%, 100% of my final 1 or 2 paychecks into my 401k? Now, I've heard every answer in the book on that from clients over the years. Some plans will allow it, some plans won't. Some plans will allow a one-time additional contribution at year end, but only up to a certain percentage of your paycheck, for example, like 50%. Whether you can do this or not, this is a plan-specific thing. This is not an IRS thing. From a tax perspective, you can contribute up to $23,000 in total for 2024. It doesn't matter from the perspective of the IRS if you evenly deferred from all of your paychecks during the year, or if there was like an extra amount contributed at the end of the year. Now, of course, a second consideration is, are you in a financial position to go without 1 or 2 paychecks at the end of the year in order to accomplish this? Only you will know the answer to that question. But if you do complete this strategy, then what happens inside of the personal tax planning template? Well, that is how you could potentially get one or both of these numbers right here to decrease before the year is over. Remember, this is going to be box 1 off the W-2. Box 1 is your total income less all of your deferral. So if your plan will allow it and you are in a financial position to do it, that's one possibility you might consider to reduce what for many people will be the largest bucket of income listed here on the personal tax planning template. Also note when you are considering this strategy that the catch-up contribution to a 401k for people 50 years of age and over is another $7,500 for 2024. So in that situation, you could employ the same strategy we just discussed, except you would have even more room. The limit to which you could contribute would be raised to $23,000 plus $7,500 equals $30,500. Now, what if you've already maxed out your 401k contribution for the year, but you are still looking for income deferral opportunities? Well, the next possibility is your annual contribution to a traditional IRA. Now, remember that anybody can contribute to a traditional IRA. There is no income limit preventing you from contributing to a traditional IRA. However, there may be an income limit on your ability to deduct your contribution to the traditional IRA. So if we look at this little summary here, traditional IRA, there is no income limit to contribute. However, there may be a possible income limit to deduct the contribution. Alternatively, over here in the Roth IRA, there is an actual income limit in order to make a contribution at all. And as we've discussed in many other videos on the channel, Roth contributions are non-deductible. Okay, right here, the income limit to contribute to a Roth IRA is why the backdoor Roth strategy is even a thing. Okay, and we will discuss that in detail in the next video. For the moment, I want to take a look down here at this list of income thresholds that allow you to deduct the traditional IRA contribution. And there's one in particular, this bullet point 3, which a lot of people overlook, and it's something that might be beneficial to you just depending on your facts and circumstances. So let's go through this. Taxpayers can deduct contributions to a traditional IRA if they meet certain conditions. If during the year either the taxpayer or the taxpayer's spouse was covered by a retirement plan at work, the deduction may be reduced or phased out until it is eliminated, depending on filing status and income. If neither the taxpayer nor the spouse is covered by a retirement plan at work, the phase-outs of the deduction do not apply. So just to summarize that, if you are not covered by any retirement plan at work, neither you nor your spouse, then you can deduct the annual IRA contribution no matter what. It's when you're covered by a retirement plan at work that kicks in the limitations. So for single taxpayers right here, the phase-out range is between $77,000 and $87,000 of AGI. and above $87,000, the deduction would be fully phased out. Now, for married couples, this is the one that most people are familiar with. The phase-out range is 123 up to 143. But this phase-out range is if the spouse making the IRA contribution is covered by a retirement plan at work. Now, bullet point 3, here's the one a lot of people overlook. For an IRA contributor who is not covered by a workplace retirement plan but is married to someone who is covered. Okay, so that basically means you're married, one spouse is covered, one spouse is not. So for the spouse who isn't covered, that spouse has a higher range. The range for that spouse is 230 up to 240 for 2024. Now I want to do a quick planning example using TurboTax, and because we're still using the 2023 version since certain modules within 2024 are not yet available, we're going to consider this range right here, which is for 2023. So just to summarize, the top of the phase-out range for the spouse who is not covered, even though the other spouse is covered, is going to be $228,000. Okay, so we're in TurboTax here. Let's just get our bearings. There's $175,000 of W-2 income. There's the $175 right there. If we add these three up right here, we have $6,300 of interest income. There's our $6,300 right over here. Okay, if we take our non-qualified dividends right there and we add our qualified dividends down here, that's a total of $13,000, of which 6 is qualified. There's our $6,000 qualified, there's our $13,000 total. We have a $20,000 RMD coming from an inherited IRA right here. $20,000 taxable IRA distribution. Then down here in the long-term capital gain section, I have $12,000 of long-term capital gain plus another $2,000 of capital gain distribution. That's $14,000 right there. And there's our $14,000 right here. Scrolling down, we're using a standard deduction of $29,200. And then scrolling further down here is our taxable income of $199,100, which agrees to $199,100 right over here. And then finally down in the tax section, our total tax in the base case is $33,017. And over here is our $33,017. Now scrolling further back up, I want you to see that right here we have nothing entered so far as a deduction for a traditional IRA contribution for either spouse. And the reason it would be 0 is because this is set up such that AGI is $228,300. And if you recall from earlier, the top of the phase-out range is $228,000 for 2023. When we go back to TurboTax and we open Schedule 1 right here, then we scroll down to page 2 where IRA deductions would go. Right here on line 20, you can see that there is nothing in there. However, I have entered 2 IRA contributions into TurboTax. We can see them right over here on these IRA contribution worksheets. So if we look right here, traditional IRA contributions, enter traditional IRA contributions made for 2023, you can see I have $7,000 for spouse number 1 and I have $7,000 for spouse number 2. But if we scroll a little bit further down on the worksheet, you can see right here, deductible traditional IRA contributions 0 and 0. Non-deductible traditional IRA contributions 7 and 7. So when thinking about this, we could look at this AGI and say, you know, we are really close to the threshold here for the spouse who is not covered by a retirement plan at work. By the way, you can see how I have set this up in the tax return right here. Check this box if covered by a retirement plan at work. And I have indicated that spouse number 1 is covered, but spouse number 2 is not. So the question is, what could we possibly do to get this AGI a little bit lower? And it really doesn't have to go that much lower, does it? The phase-out range is $218 up to $228, so it only has to go down about $10,000. So there could be a variety of possibilities, but the one I was thinking about for this example is take a look right up here. We have a long-term capital gain that we are projecting of $12,000. We have capital gain distributions of $2,000, that's $14,000. This could be a great time to harvest some capital loss if we have it available. A lot of people, when they think about harvesting capital loss, the only thing they really consider is, well, it'll offset my capital gain. And that's true, and that's nice, and that will give you a tax savings. But there can be so much more to it when you become aware of the rules and learn what the thresholds are for other things. If I can bring this down right here by $10,000 by harvesting capital loss, not only will it reduce my taxable income here by the $10,000, but it will bring this AGI below the bottom of the phase-out range and allow that $7,000 over here for the second spouse to become a deductible item. So let's try that. I'm going to go to my step-by-step view. I'm going to go to personal income right here. I'm going to choose what I want to work on. I'm going to go down here to the capital gain and loss section. Note this only shows the 12 because the capital gain distributions are hidden up here in the dividends section for purposes of the data entry into TurboTax. But I'm going to go in here, and right now in this first row, I just have a placeholder right here where the proceeds from the sale and the cost basis are the same. Let's just adjust this and assume we have a cost basis of $211,000. That would give us an $11,000 loss. So I'm going to edit this. I'm going to change my cost basis right here to 211. And you can see right here that we have harvested an 11,000 short-term capital loss. Now, before continuing, let's go back to the personal tax planning template. We have enough long-term capital gain right here to absorb that $11,000. So it's going to offset this in the long-term capital gain section. So I'm just going to change this number to 1,000. That will reflect $12,000 of long-term capital gain offset by $11,000 of short-term capital loss. And we should be able to see that over here on Schedule D if I scroll down. Part 1 is the short-term capital gains and losses. There's my negative $11,000 loss. Scrolling further down here to part number 2, there's my $12,000 of gain. Capital gain distributions will appear down here at the bottom, $2,000. And ultimately the result will be $3,000 right here, which reflects this $1,000 plus the $2,000 right there of the capital gain distribution. Now, another item we will have to drop into the personal tax planning template is the $7,000 of deduction for spouse number 2 because AGI is now lower than the $218,000, which was the bottom of the phase-out range. So I'm going to go right here and type in minus $7,000. And if we go back over here to TurboTax and we look at the IRA contribution worksheets again, okay, now when I scroll down to the second section, there we go right there, deductible traditional IRA contribution for spouse number 2 is now $7,000. It got moved from non-deductible up to deductible because by harvesting that capital loss, we were able to get AGI below the necessary threshold to make the IRA contribution for the second spouse deductible because of that higher phase-out range for the second spouse that wasn't covered by the retirement plan at work. So now if we go back to Schedule 1, I'm going to scroll down here to page number 2, and there it is. IRA deduction of $7,000. So again, not only did we reduce our capital gain by $11,000, but by harvesting that capital loss, it allowed us to get below the threshold necessary in order to take this $7,000 as a deduction. Now, of course, as we always like to do, let's just double check the tax. I'm going to go to the 1040 here. We're looking at $29,827. And if I scroll all the way to the bottom here in the personal tax planning template, $29,827. So that was an example of tax planning where you kind of get a double benefit just for one change. Again, not only did we offset $11,000 of gain, we got an extra $7,000 of deduction as well. By the way, if you are interested in the personal tax planning template that you have seen me using throughout this video series, there is a purchase link for that program in the description below this video. Also, remember that my 2024 tax return preparation class kicks off on January the 15th, 2025. If you're interested in signing up for that, you can find a link to that class in the description below this video as well. Alright, that's going to be it for today's video. Make sure to tune in for video number 4 of this series, where we will continue the discussion of 401k and IRA strategies, with discussion of the backdoor Roth and the sort of related mega backdoor Roth. I'll see you next time.